All right, welcome everyone. New Harbor's 2026 live Q&A, first one of the year. Today is January 15th, 2026. We're on our new platform here through YouTube. Regina set us up here, and we'll give a minute for everyone to start logging in. We do have a chat area as well. You should see to the right side of your screen here an area to comment and make chats. We have a series of questions that people have asked to us as well. And we've got Mike Preston, John Lodra, Jay Mayer, Regina Milcani here, all of us here live, ready to answer these questions.
Thank you all for joining us today. Happy New Year.
I'm glad everyone's here. Thanks for coming.
All right, I'd like to kick it off with a general overview. Mike, maybe you can kick us off with this, but the precious metals market. We've had a lot of questions as of late. The price of silver, gold have really catapulted in the coming weeks and months, and maybe you could kick us off here with a precursor to that.
All right, everybody wants to talk about precious metals and miners. History tells us that when a trade gets this hot and it goes parabolic and everyone wants to talk about it at the same time, it tells us to slow down and be careful. At the same time, it's difficult because we have a viewpoint, as do many of our clients, that we are living during a time of extreme central bank intervention and an era that's likely changing. In other words, the world's starting to wake up, we think, probably to the fact that central banks can't just print money forever. It doesn't make sense. It just doesn't make common sense. So those two things together are difficult to navigate for all of us. We think we're finally seeing everything that we thought we'd see, and at the same time, it's going so fast that it feels dangerous. So I can say that we're having a lot of conversations with people, and we're reviewing exposures. There's no exact or easy answer to this. We do think that gold and silver and miners will likely go higher from here, but they are extremely extended. I mean, silver's just been up $5 or $6 every day, touched 90, pulled back a little bit, snapped right back today. And I mean, I could share some charts either now or a little bit later, but it's gotten really, really extended. We've long said that people should have 5 to 10% physical metals. Anyone that took our advice years ago is probably 20 or 30% physical metals now. And that's still okay if you review your own psychology about it and your own financial situation. But we're really telling people to think about taking a little bit off the table, think about selling something. And a common response to that is people say, well, I don't want to sit in dollars. I don't have anything to do with the money. I want people to make up something to do with the money. Do that, do whatever you've been wanting to do that you haven't been doing. Do the renovation to the house or the big trip or whatever, so do something, because it just feels better mentally to do something. And if it keeps going higher like we think it will, it's going to be back to the same level again. So this is not about winning, being the champion of the world in terms of picking the top in metals. This is about ringing the register when you've been right. So those are a lot of the conversations we've been having. If you don't have any gold and silver, that's a tough one too, because we think you should enter somewhere carefully. We'll be happy to talk you through that. But we would start with something on the small end at this point. The gold-silver ratio has gone from 103 in April to 52 now. It's normalized. The long-term average is maybe 40 to 60. So it's not a screaming, benefit to buy or hold silver versus gold here. So there's so much more there that we've been talking about. But I would say 50% of the conversations right now are about this. And so I would say that at some point here soon, we're going to go into a consolidation where for a couple of months it's going to be boring again, so just be really, really careful. If you're feeling emotional, that's what we're here for, is to help you through that and to filter that out and help you make the right decision. So reach out to us. I'll stop there.
Anything to add, John, to that?
I'll just add just the kind of broad framework in which we think about precious metals, and to excuse the pun, they are not the silver bullet. They are not the perfect investment vehicle for all purposes. And we have long thought of precious metals as having two purposes. One of kind of like an insurance policy, just like you have an insurance policy on your car or your home or your life or your health. You don't need to have an excessive amount of insurance to provide protection against some calamitous outcomes. And the main insurance value of precious metals that we believe is important, and this goes back millennia, and even central banks themselves see it this way. It's a insurance policy against debasement of fiat currencies, which can be literally printed, to oblivion. It's a bit of an insurance policy against inflation, and which is another way of saying money printing and debasement of currencies, but also against systemic failure in the financial markets. Central banks themselves have been increasing their purchases, and one of the prime reasons they indicated was the lack of counterparty risk. The world has become less trusting of each other, financially and otherwise, and is there really the financial wherewithal to back up a lot of the financial promises in the system? You don't need an overly huge size position to check that insurance box. And then there's the investment part that a lot of the price action of late has certainly delivered strong investment returns. And like with any investment that has gone perhaps too far too soon, it's very sensible to take some chips off the table. That's all I'll add there.
Thanks. I'll add one part, be mindful of tax ramifications. We're not trying to give advice on taxes here, but there's a difference between selling physical metals that could be in a vault in different types of accounts, be it IRAs or Roths, taxable accounts, and then of course the paper metals, the ones that might be in some of the ETFs and such. So before you go just sell things, let's maybe chat about the tax ramifications of it, or reach out to your accountant to talk about that. John, I'm going to kick off our first question in the realm of financial planning and asset management, and I'll read it here. This is a client of ours. I have a moderate amount of wealth, partly with New Harbor, and I'm getting old and would like to consider things like inheritance, tax options, giving some precious metals and/or assets away. Is there one specific book that lays out the ground rules on alternative approaches like this?
John, you have to come off mute.
John, you're muted. Yep.
Oh, someone's going to have to tap John.
You're muted, John.
There we go.
You hear me?
There you go.
No,
all right, sorry about that. There must be a delay. Thank you. I appreciate that question, because for us, it reminds us what we do here. We're obviously hands-on tactical investment managers, but it's all about the real people that own these assets. It's about our clients and their lives. And this speaks to the human purpose of what money hopefully can do for one's life. So I can't recommend a specific book. This is something we think about all the time, because part of what many of our clients like to do. But let me just perhaps, short of recommending a book, I'll cover some basic strategies that everybody should be aware of. So there's basically the idea of making gifts while you're alive and making gifts at your death. Okay, lifetime gifts versus gifts at death. And many people don't realize, but any individual can gift tax-free, both from the donor, you're the donor, as well as the recipient, up to $19,000 in 2026. It changes potentially every year into the future, but for 2026, any individual can gift to any number of other individuals, be they family members, friends, whomever, $19,000 of value, cash or otherwise, without it requiring a gift tax return. Okay. There is also, and married couples, for example, can double that. They can gift together twice that as a joint gift to any number of individuals, children, friends, family members, whatever. There is also what's called a lifetime gift exemption. And this plays very closely with the estate tax exemption. And I'm talking just federal here. Every state has its own rules, so I'm not going to cover state rules here. But at the federal level, right now, the individual estate tax exemption is $15 million per person. That has gone up tremendously over the last bunch of years. There was a time where it was 1 million, 2 million, and was at risk of getting reversed back. Recent tax law changes has increased that substantially. So for many people that own less than $15 million in assets, estate taxes aren't even an issue, because you can die with up to $15 million, $30 million for married couples, $15 million per spouse, without any estate tax owed. You can also choose to use some of that estate tax exemption by gifting amounts in excess of that 19,000 per year, and through what's called the lifetime exemption. You could gift up to 15 million during your life, but then you'd be using away using some of your estate tax exemption. So those two things are straight gifts. Now, those are gifts to people. Of course, there's also the idea of making charitable gifts to charities. And there's a lot of different ways you can do that. There's, for example, a donor advised fund that you could set up and gift into. And a donor advised fund allows you to gift a chunk of money at once that you can then choose when and how to distribute over time to specific charities. It's a way to kind of like get an upfront potential tax deduction depending on your itemization versus standard deduction, and make that gift up front, but choose where and when over time how to make those gifts. IRAs are an important thing to talk about as it relates to charitable giving. There's a provision called the Qualified Charitable Deduction, a QCD, that basically allows one, once they reach 70 and a half, they can begin to gift up to a certain amount of their IRA directly to a charity without it being taxed as income to the owner of the IRA, like a traditional distribution from the IRA would. And it can even be used to satisfy what are called required minimum distributions when the IRA owner reaches now age 73 and they're required to start taking distributions. Again, it's a way to avoid income tax on those distributions, but at the same time giving directly to a charity that also doesn't bear any tax liability. One thing I want to make remind folks that assets that are held outside of retirement accounts enjoy under the current tax code a step up in cost basis at one's death. So, generally speaking, if you gift stocks, appreciated stocks or gold or anything like that to a charity, you don't pay the tax. The charity doesn't pay the tax. But if you gift it to an individual, like a family member, they're going to inherit your basis and then owe capital gains if they sell that asset down the road at a higher price. Whereas if they receive it at death, it will receive a stepped up basis and they'll have no capital gains liability. There are a lot of different tangents here, but those are some of the common things I want to just make people aware of. And certainly I'm speaking to our client that asked that question. Feel free to reach out. In fact, we'll make sure we reach out to you to talk specifically about this. But hopefully that was a good high level landscape for folks to go.
Thanks, John. John and Jay, maybe you both take this one. What are New Harbor's thoughts of private equity investments now allowed in the 401k plans?
Okay, so I'll just highlight a couple things. Can you hear me okay? I just want to make sure. Okay, so we have a YouTube channel for those that may not be aware. In fact, I think you're logged into that channel right now. Several weeks or months ago, I lost track. I did a video on this specific thing back in, I think, August. I may be off, but President Trump signed an executive order to lay the groundwork for qualified retirement plans like 401ks, 403bs, things like that, to allow owners of workers in those plans to invest directly in private investment, private equity, private credit, things that aren't traded on an exchange. And that video, I encourage you to watch it. I'll cut right to the chase. I was pretty critical of the idea because we always think about what are the incentives here. Basically under the auspices of democratizing access to everyday investors to these kinds of investments that have long only been accessible by sophisticated, large, accredited investors. Now suddenly they want to be made available in like everyday retirement plans. Now that's all well and good, but we broadly think we're in a very extreme financial market bubble. Asset values are elevated across many asset classes, including private investments. They're not like in their own little world. And in fact, if you look broadly speaking, there is some stresses in some of these vehicles. Broadly speaking, for example, the private equity industry is having a hard time exiting businesses. Essentially what they do, they buy shares of private businesses and they return the returns to the shareholders or investors, limited partners as they're called, by selling those companies out of the portfolio. There's been a kind of a stalemate of sorts where investors in those funds want their capital back, but the private equity companies aren't finding, convenient or exits at the valuations that they want to have. So our skeptical read of this is that it's a way to kind of, provide liquidity to the big sophisticated investors at the expense of small investors holding the bag, basically. So broad way of saying buyer beware. I want to highlight Jay is in the middle of authoring our newsletter for the month that goes specifically into private investments. And Jay's got a unique background here. He worked in asset-backed lending, so he's seen from the literally the ground up how some of these companies operate. So Jay, please feel free to offer any additional comments there.
Yeah, it's hard to follow you up, John, as always. But I would just say that everything you said is spot on. You gotta know what's inside of the investment to feel comfortable with it. You have to be ready for lack of liquidity. There's usually liquidity restrictions on mutual funds where you might not be able to sell it at all or sell it quarterly, and they only tell you how much you can sell and don't let you sell everything. So right when you need the money the most, you might not be able to get it. And of course, there's obviously very sketchy valuation methods that go on behind the scenes with some of the private companies. Something you'll hear a lot is about companies tripping debt covenants. In the private market, in public markets, you hear about it and the company immediately gets hit on their stock price. In private markets, the manager might say, you know what, why don't you check in with us in a quarter? That wasn't a big deal. We'll talk about it. And so you can have this kind of can kicking. And, a lot of private investments are sold as low volatility. That's because they're not traded. Sometimes it's good, sometimes it's bad, right? Because you won't be able to know when things are really hitting the fan until it's way too late. So I think everything you said there is perfectly accurate, John. You just have to be sure you know what you're doing when you buy these things and make sure you keep the allocation low. And exactly like you said, why now? Why are we getting plugged to buy these now? And why weren't we 5 years ago, 6 years ago? So agreed.
Thanks, Jay. Mike, this one's for you. What's your perspective on annuities purchased through a bank?
All right. Had to find my microphone button. Well, annuities in general, I could talk about. Some of them are sold through banks. Some of them are sold through brokers. There's really not much difference. Annuities sold through banks tend to be equity index annuities or fixed annuities. But an annuity is simply a contract with an insurance company. That's the first thing you've got to know. You have to know that you're buying an investment or you're buying a contract with an insurance company. And so the performance of that contract depends mainly on the performance of the insurance company that you're investing with. There are some annuities called variable annuities that depend more on the funds or the sub-accounts that are inside of them. But as far as equity index annuities or fixed annuities go, for the most part, you're putting your trust in the full faith and credit of that insurance company. So it's not FDIC insured. So there is some credit risk that comes with annuities. Also, annuities cost more in terms of ongoing administrative charges, annual charges, and mortality and expense charges. So you could be paying 3+% per year, sometimes up to 4% a year for an annuity in exchange for a contract with a company that says, we're going to pay you back. And hopefully they do pay you back. But that contract with them essentially is going to be either a promise to pay you back plus interest or a promise to pay you back plus some kind of movement in an underlying index like an S&P 500. Oftentimes it's an esoteric custom index that's really hard to look up and track. It's very common with equity index annuities. So don't love them. Okay, I'll be straight. And anyone we talk to, I'll tell you that those are some negatives that you need to know going in. Now, are there some good things to say about them? Yes, they're pretty marketable and people love to buy them because they feel like they're getting a guarantee. For instance, if I put $100,000 into an equity index annuity and then I'm promised, well, you're never going to have less than 0% return in a given year, that's true. Now you're giving up something for that. You're giving up a lot for it. But a typical equity index annuity will look something like that. Put your $100,000 in, and here's the caveat. You got to stay there for 10 years, number one. Number two, you only have like 4 or 5 choices of indexes. And so what you really have there is some kind of hybrid fixed income product with very high surrender charges. Usually if you want to surrender more than a certain percentage of the annuity, you're going to have to pay up to 10% in the early years to get your money out. So once you're in them, you're basically stuck in them for a long time, and you at best hope to do better than some kind of fixed income or bond equivalent. We have used and still do use once in a while for the right person or the right case fixed annuities. I think those are better. A typical fixed annuity will look something like this. You go with a high quality insurance company, you put your money in, they guarantee you a certain interest rate, let's say 5.1%, and it's compounded over 5 years and you get your money out. It's just like a CD, except it's not FDIC insured. That's the big caveat. It's not FDIC insured. The interest, unless you take it out, is compounded tax deferred, and that's a kind of a cool thing. But for most people, we don't like annuities. We've talked to a lot of people and been in the business a long time and have encountered a lot of annuities, and most people don't know what they're buying. And I think a lot of advisors don't know exactly what they're selling. There's a lot of variable annuities out there that have these income benefits attached. And people think, well, geez, I can never earn less than 6%. That's called a GMIB, or a guaranteed minimum income benefit. It's common. Transamerica, Equitable, Allianz has it. A lot of companies have it. But we have to point out that the guarantee is not 6% on your money. It's a guaranteed benefit base of 6% that increases every year. And then you have to annuitize that fictitious benefit base. And essentially what you're doing is buying a pension. And that's okay, but you have to know what you're doing. So coming full circle, what do I think about annuities being bought through banks? I think that most people don't know what they're buying. And I think that most bank representatives don't know what they're selling. Can it be good in some cases? Maybe. Like, for instance, the person that feels like they have to have some stock market exposure, but's really scared. I mean, one good thing I could say, I guess, about annuities in this case is they guarantee against loss, usually, depending upon which one it is. And if you're ever going to have some kind of strap-on insurance benefit against market loss, it should be at the top of the biggest bubble we've ever seen. But we would also say don't bother. Just sit in treasury bills and wait for the big downturn. So I hope I gave it a fair shake. We talk a lot about annuities. We've seen thousands of them. We probably have well over 100 or a couple hundred on the books even now, just from people that we've met that have already had them. We do our best to help people understand them and make some kind of graceful exit if they want to do that and make a decision about what to do. So not a big fan. That's my underlying message. I think I'd be really careful. Happy to give you an objective opinion if you want to talk to us directly.
Justin, I've got one quick comment to add to that, and this dovetails on the subject of private investments. One of the trends that has happened, if you go back a decade, many might recall that the Federal Reserve forced interest rates down to zero, and all kinds of investors chased yield because they literally getting zero in traditionally safe assets. That wasn't just the individuals, it was also industries. And the whole private credit, private lending kind of boom took hold and offered higher yields. So some insurance companies have dramatically increased their portfolio into private credit instruments that have higher yield but higher risk, and frankly missing a lot of the protections like the traditional debt covenants that many other fixed income investments entail, all to chase yield and say, hey, look at our fixed annuity, we can offer a higher rate than what you can get elsewhere. So yeah, that's great, it's all well and good until we see some stresses, which we think are bound to happen in that space. It's been a very much a hot area for the last many years, and we're starting to see some stresses. There were some high profile examples with like Tricolor and Blue Owl, I think, earlier this year. Point being is that some of these insurance companies may have gotten way out over their skis in terms of the quality of their portfolio to in pursuit of offering higher yields to people to buy these products, basically.
Thank you, John. No free lunch, and many of these variable annuities do cap the upside too. So it might say you could participate in the first 10% of the growth of the S&P 500, and then they keep the rest, things like that. So there's definitely no free lunch. John, next question to you. What in New Harbor's view is the best way to measure the real loss in dollar purchasing power over time? And what are some ways to hedge against personal wealth against that loss?
Okay, great question. Again, I like it because it brings it back to how does this impact me as a person, right? A real person that has a life. So there are all kinds of policy benchmarks of what inflation is, CPI, PCE deflator. There's all kinds of these wonky measures of inflation. And sometimes those headline measures say, indicate, hey, inflation has cooled, but everyday people are saying that hasn't cooled for me. I feel like I'm still living paycheck to paycheck, or that my pocketbook is not going as far as it once did. And that's where it gets, my response is like, every person has their own CPI, so to speak. They have their own areas where they spend money, want to spend money, or use certain goods and services. So what one person's cost of living is a different for another person. So, it really depends on what you consume. And like, for example, one of the big sticky parts has been housing. Someone that owns a home and long ago paid off their mortgage and doesn't have to pay rent, it hasn't been feeling the housing crisis as much as, for example, a young person starting out that can't afford a home. Rent prices have been off the charts. Their cost of living feels a whole lot more difficult than someone that maybe doesn't see that in their daily expense. Interesting. There's a service called Trueflation that they purport to measure inflation in real time in a way that's much more data sensitive than some of the federal agencies, for example, that track it. And I'll just share my screen here just so you can see this website. And they actually have a tool that purportedly allows you to kind of enter your own kind of budget and get your personal inflation rate. I'm not endorsing this as a product. I'm just saying the idea is that everybody's going to have their own cost of living. How can you manage that? Well, first of all, be mindful of where you're spending your money and try to look for ways to mitigate some of those expense pressures, if you will. But also, how you invest your money is really important. The most notable inflationary period that we can talk about in modern history is the 1970s. In fact, it was stagflation, where prices inflated and growth was stagnant. That's almost arguably a worse scenario than just inflation alone. But if you look at what did well as investments in the 1970s, the answer is not much. Most people think stocks are a great place to be to combat inflation. Not really the case, especially when you're starting with very high valuations. In fact, in the 1970s, even though the stock market, the decade, I think, between late 68 and the early 80s, that period of time, stocks pretty much went almost nowhere on a nominal basis, a non-inflation adjusted basis. But when you adjust for inflation, they actually lost money. You lost purchasing power. Bonds even worse. What did well during that period? Things like real estate, commodities, gold, real assets, tangible assets. And we think, broadly speaking, that is a favorite place to be in the years ahead, because we do think inflationary pressures will be persistent. They may pull back here and there, but we think with the setup of fiscal and monetary policy realities we have, the next 10, 20 years is likely to be more sticky and persistent inflation rather than the opposite. And so that's why we still like precious metals despite the run they've had. We like commodities. We've seen a lot of interest and momentum in other commodities, base metals, things like that. Treasury inflation protected bonds can be a good place, but they're still bonds. Back in 21 to 22, when we had this more recent spike in inflation, ironically, cash was the best place to be. Stocks did poorly. Inflation protected bonds did poorly. Real estate can be a good place as a real asset. And honestly, non-U.S. assets, things like emerging markets, stocks and bonds, and properly valued or at least not overly valued, extremely overvalued foreign stocks can be a good place to have some money, like we do in our client portfolios, to combat what we think will be a persistent inflation.
Thank you, John. Mike, I'm going to pivot. Jay, thanks for all your work answering these questions live chat. There's one that came up. I recognize the name. And Mike, I might ask this to you from Joe. What asset class do you expect to do well for this year, 2026?
Oh, wow. Well, we're already 15 days into it, right? What do I think will do well this year? Overall, I don't think stocks will do well this year. I think stocks will end the year down. These are just guesses, by the way. It's just we've been notoriously early, and so we have to give that caveat. But where we are in the story, I think it feels like we're going to get some kind of blow off top and then a big drop in the market. So I have a hard time believing that stocks will end up this year plus. And gold and silver and miners have had a fantastic 2 years. It's hard to believe they're going to have a fantastic 3 years, but they might. I feel less confident about that from these levels. I mean, silver is trading at around 90 right now. So, geez, I don't know. If I had to guess, I think bonds, long-term high-quality bonds will do well. And it's been a little bit of an underperformer in our portfolio, but we have a 7.5% position approximately in TLT, long-term U.S. Treasury bonds. And I'm looking at the 10-year note right now. The 10-year is 415, and the 30-year is 478. It's been talk, and I guess maybe it actually already happened, of $200 billion of buying of mortgage bonds. Trump and Dissent want mortgages down. They'll do almost anything, including coercion, to get it. And I think that the one thing that will give them all the ammo that they need is a stock market top and drop. So when that happens, I think that we see rates go down, and I think high quality bonds go up. So, this is not a fantastic, it's not like a sexy or exciting trade. I wouldn't expect a double like we've seen in silver in just a month or two, but I wouldn't be surprised to see TLT at the end of the year at, 110. And it's at just under 90 right now, 89. So that could be a good trade for this year, and one that's not very, very risky. The other great trade, I think, for people that are managing their own money or self-directed or passive, is just to sit and wait in treasury bills, get your allocation down. If you were to ask me what I think a safe allocation is, if you're passive, it would be 30% or less stocks. Because with that, you can add more later. You can withstand whatever comes psychologically. But for this year, I think bonds will do well. And the sectors that we have highlighted in our portfolio, we're always looking at relative strength of various different sectors versus the S&P. And I think those will continue to do well. I mean, commodities had a great year last year. I'd like to think that commodities will have a good year again, particularly if crude oil can kick in. That's been a laggard. But if you look at the other things we have, like healthcare and utilities, industrials, I think we can get some decent performance out of them. I just don't know when the big drop's going to come in the market. That's really our job, is to react to that and to lighten up exposure, hopefully ahead of that, or at the very latest in reaction to that when we take our stops. And I just don't know that we're going to last the whole year without that big drop. So that's why I'm concerned about stocks.
Next question to you, Mike. Deflation. Is deflation a possibility, and what might be the way it could happen?
Absolutely. I mean, if I had to guess, I think that's what is going to happen. And the way it happens is a crash. That's it. An asset price crash. All of this support fails. The bottom falls out of the market. The Fed comes to the rescue. The market doesn't care. The market falls more. Soon after that, the real estate market starts to fall. Soon after that, unemployment goes up. It's this big vacuum of deflation. And the last big deflation was the Great Depression. People think that can't happen again, but deflation, I think, is likely if we get an asset price crash. And I still think that's likely. And that's what will cause bonds to go way up. High quality bonds would go way up under that scenario. So I know a lot of people are worried about going right into hyperinflation, and I suppose that's possible, but we know what central planners are going to do. They're going to print like crazy. They're going to need an excuse to print like crazy. Last time they had COVID, okay, they got away with that one. $7 trillion worth of printing. We can argue about that. Some of that was probably necessary, but the world learned that inflation is the result of that post-COVID. And the next big drop, they don't have any other plan, just one plan, and that's printing more money and changing the rules, which is essentially equivalent to printing more money. And if the world wakes up and says that's not working anymore and we're selling anyway, because, by the way, that's what happened in the last two big crashes for a while. Ultimately, there was a bounce, but the central planners printing did not rescue the market from those declines. And so since we're trading at around 3 times equilibrium values here, we could lose 2/3 and not even be undervalued. And so if we're on the way down and the printers come out and the market doesn't care, we've got deflation. That's what the Fed's scared about. That's what everyone's scared about. And it's a very fragile point that we're at. And so can I guarantee we're going to do that? No. But that's what I think will probably happen.
Thank you, Mike. John, switching over to international markets. Question here. International markets and emerging markets have seen strong flows. The Europe market has price per earnings in the 17 range with much debt. Now, are the flows based on fundamentals or diversification hedge against U.S. speculation? What are our thoughts there?
Okay, yeah. So many people don't realize, we certainly do because we watch this all the time. Last year, much stronger than the U.S. stock market were foreign stock markets, both emerging and developed markets. And this is frankly, something that we have been waiting for a long time. If you look at the valuations of the U.S. stock market, we are in the rarest of valuations. We are at valuations. I'm not talking about level. I'm talking about multiples of earnings and things like that. We're at levels that we have never seen before. We've eclipsed the tech bubble peak of 2000. We're way above where we were in 2007 before the housing bust. We even have eclipsed the 1929 peak before the Great Depression. Now there are a lot of explanations and theories as to whether that's different this time or not, including the record profit margins that especially some of these large hyperscaler technology companies have. I'm not going to get into that right now, but foreign markets have enjoyed quite a more attractive valuation. Some of that has been priced into the market with last year's moves, but we still think that by and large, non-US markets are much more attractively valued right now. And not just us, but you can look at some objective data. I'm going to share a screen here. This is a screen that a data series that Research Affiliates puts together. And it's kind of a busy chart, but I just want to use it to highlight a couple things. This chart shows for a bunch of different countries what's called the cyclically adjusted PE ratio, CAPE, cyclically adjusted PE ratio. And what I want you to just jump to is notice there's an empty circle and a kind of a range for each of these. Where I want you to highlight is where you see the circle way up at the top of the range. That's U.S. large cap stocks. What you can see here, this is the current valuation. The current CAPE ratio is 39.63. That's in the 99th percentile. What that means is that 99% of the time, the valuations have been lower than where they are right now. That means that prices would have to come down to get back to normal. Compare that to some other countries where the empty circles at the lower end of the range. For example, Brazil, it's only in the 22nd percentile of its historical valuation range. Look at places like this, Turkey. Look at places like Indonesia. Look at places like the Philippines. A lot of the Latin American markets are in here. And that just basically, if there's one iron law of investing success over the long term, is to not overpay. Valuations matter over long periods of time. They don't matter over short periods of time. We saw, for example, the tech bubble in 2000. The NASDAQ went up from October of 99 to 5 months later, March of 2000, went up 80% in 5 months. But then it proceeded to lose 80%. And the round trip there was not a 0% return. It was like a negative, almost 70% negative return for folks that rode that up and down. Point being, valuations are much more compelling, even with last year's performance. Now, there was talk about debt and things like that. So one of the reasons that non-U.S. assets have done well is the weakness in the U.S. dollar. And that weakness is structural and probably a trend that will continue for a lot of reasons. The monetary policies, the fiscal situation, a global desire to flee from the dollar. Central banks themselves, in the annual Gold Council survey of central banks, over 70% of the world's central banks indicated that they're likely over the next 5 years to reduce their holdings of US dollars as a reserve asset and increase, for example, their holdings of gold. Not only are they saying that going forward, but they've done that in spades over the last handful of years. It's ironic that once we were thought as a developed market and other markets. Just the other day, there's a widely publicized feud going on between Jay Powell, the current chair of the Federal Reserve, and the federal government. A legal argument over some technical details. But the world central bankers signed a letter with Powell basically saying this is threatening the independence of the central bank. And this is what happens in emerging markets. Banana republics, in other words. What typically identifies a banana republic is stuff like that, but also excessive debt relative to economic activity. We now have over 130% debt to GDP in the US. And that's not even counting the entitlements, things like Social Security and Medicare. So in some ways, our debt situation is more dire than some of the traditional emerging markets who have growing economies, who have demographics where there's a lot of young workers. Unlike here, we have a demographic that is the baby boomers are starting to retire. There's going to be fewer and fewer workers to fund the engine of kind of our entitlements. And it's not a easy debate to have, of course. But point being is we do believe that despite traditional views on debt and things like that of emerging markets and non-US assets, that not only from a valuation standpoint, but the very technical indicators that we follow showing relative strength and trends and momentum very strongly still support non-US investments. And that will change at some point, and we'll watch for our signals to help guide us in that regard.
Thank you, John. Next question on some hedging ideas. What are some ways to hedge vaulted precious metals that you don't want to sell, and how might you accomplish this?
Is that for me, Justin?
It is, Mike, yeah.
There's not really many ways to do it. That's the bottom line. If they're vaulted, you can buy puts in the options market, but I'm telling you, you're going to pay 6 to 8% a year for at-the-money protection. I could show you that on the option chain, but take my word for it. If you have, I'm going to always use this number, 100,000. I know some have less, some have more, but it's a nice round number. If you have 100,000 in gold, it's going to cost you 6,000 or 7,000 a year to hedge that with puts near the money. Now, for some people, that might be worth it here, but you're going to have to open an account. We can do it for you, put some cash in there, and then buy those puts, which is an option called a put, which is an insurance contract. Maybe it's worth it to do it, at these levels. Maybe it's worth it in silver. If you want to talk about that, talk with us. But the question said that the metals were in the vault, so that really limits the things you can do. The number one best thing to do is sell some on the way up. As I said earlier, sell some on the way up. Sell 10% right here. Sell 15% right here. It'll free up your mind and it'll make you feel better if we have a big drop. And if it's in a vault at, Hard Asset Alliance or Gold Money or something like that, you just get online, make sure the price is good, and go ahead and do it. I don't see any reason not to do that, particularly if it's in an IRA. It's even easier. Now, there's a lot of slippage when you go ahead and sell gold and silver, so you don't want to be trading in and out of it if we're talking about bullion and vaults. But if you're like most people that bought this lower, that means you've doubled or tripled or more your money here. So what's wrong with selling 10%? That's the best thing I could say. Sell some. Happy to look at your situation. If you don't want to sell, we can talk about puts, but you're going to be paying out of pocket, and most people don't like to do that for very long. I can't really think of any other way to do it if it's metal in a vault. So I'd say have a conversation with us.
Thank you, Mike. Next question is you too, Mike. And I just read it. This is like a layup, I guess, but also a tough question from a client. The psychological aspects of money are difficult to grasp, especially when there are stress. You work with people to guide them through this process of understanding not just money, but how to use their money wisely. What couple questions do you wish we clients would ask you when we typically that we don't ask?
What's the happiest you can remember being in the last 5 years? And what were you doing? What would it take to do more of that? Or asked differently, what makes you happy? What makes you forget all the little problems, even just for a little while, and makes you really present and makes you feel good? Those are the things, right? If you weren't doing what you're doing, what would you do? I've been asked that question. I'd be a therapist, I think, or a social worker. Absolutely. If you're still working, what would you be doing if you weren't doing that? Or if money wasn't an issue? a lot of times people are just stuck, and it's not their fault. It's just because it's how life is. You go through hardship, you make it through, you scrimp and save, you get to the other side and you forget why you did it, and you're still scrimping and saving the rest of your life, and you never use the money. That's how most of our clients are. And so it's not like there's anything fancy or special about it. It's certainly not, we're not licensed therapists, but we do ask the questions, and particularly if it's a couple involved, a married couple or not married, even just a couple. And we often ask these questions and we get different answers from both sides. And again, it's like therapy because it gets you talking. So, you know, one might say, I really wanted a house on the coast. And the other one said, geez, I really want to spend, you know, winters in South America or something, you know, and just think about doing that and then do it. Sell. If you have an overweighted piece of gold and silver, great reason to do it, you know, and buy that property or fix up the house, like I said earlier. But what do you really want to do? Because life goes by fast. And for anyone that's been through tragedy and stuff earlier in life, you know, or even later, you just know it just goes by fast. And the most important thing is what makes you happy and why aren't you doing more of that? So, you know, we often have questions like that. And look, this life isn't perfect. And that question isn't perfect because let's face it, anything could happen at any time to take that happiness away. But when it comes to money, money isn't even that big of a deal unless you have none. Sounds really crazy for money managers to say that, right? And, you know, money fills your belly, like a client of ours said this week. Money fills your belly and puts a roof over your head, you know, but it doesn't do everything. But it can do some things, like, you know, some things that you were holding off doing. So we would say do that. And if we have to connect that goal to selling some position that's getting too big, then that's what we do. So those are some questions that we go through in a typical conversation.
Thanks, Mike. John, this one's to you. How do you expect the upcoming Supreme Court's decision to impact silver stocks?
Okay, so firstly, I presume this question is the Supreme Court expected decision on Trump's tariffs. I believe that's probably the basis of the question. The Supreme Court was expected to possibly issue a ruling yesterday, actually, on the legality of the Trump tariffs. There's a whole kind of body of law that, you know, questions whether, yes, they are, no, they aren't legal. That's not what I'm an expert on, nor any of us here. We're not going to comment on that. But it is a big deal because a lot has been priced into markets, assuming, you know, so it's not debatable that there's a significant amount of revenue coming in from the tariffs. I'll just relate a personal experience. I've been guilty of collecting bicycles. I have more than one bicycle. I'm ashamed to admit how many I have, but I bought a bike rack recently to help me organize those bicycles. And I didn't know it, but it was a European made product. I just bought it online. And then like 2 or 3 weeks later, I got a bill from DHL Worldwide Logistics, I think, for a duty, basically. I had no idea that I was going to be asked to pay that. It was not insignificant. It was several tens of dollars, if not 100. I forget what it was, but it was unexpected. So I saw firsthand that, you know, yeah, sometimes these things come right to consumers. And what this, you know, what the bond market is priced in a less dire fiscal situation by virtue of these revenues. If you start to take out those revenues and you don't, you know, the whole Doge and government spending, you know, promises that failed. There wasn't material reductions in spending. In fact, the debt issuance and the budget deficit looks as persistent as ever as we look into the future. So in a vacuum, you know, if the court were to reverse those tariffs as being illegal, in theory, we'd have to refund those monies. The question, who do we refund those monies to? Who knows? That's a whole nother mess, right? Is it the product providers? Is it the consumer? Is it the shipper? You know, that's a big nest that I don't know anybody has the answer to. But point being is the likely outcome of this is probably, in a vacuum, interest rates would go higher in the short term on longer term bonds, because it would suddenly price in a less sanguine fiscal situation for the U.S. Budget. And fiscal situation. The dollar would probably get stronger because the Federal Reserve would not have the justification nor the cover to drop rates as quickly and as much as the market believes they will. and things like that. Higher interest rates, stronger dollar in a vacuum is generally a headwind, perhaps not even an anchor for precious metals in a vacuum. But like with most things, there's many factors. We still have geopolitical instability. We still have central banks looking to de-dollarize. But on balance, I think it would probably add some headwinds in the short term to precious metals, silver especially. But it's anything clear that the court did not decide yesterday. So the ball has been punted to the future, and I don't even know if they've got any timeline for when they might issue their ruling or finding on those tariffs. So it's still a wait and see kind of game, unfortunately.
Thanks, John. I'm going to kind of speed through a handful of these questions, maybe not in the same order we looked at them here now. But Mike, for you, this person's asking, about 40% of my overall retirement accounts are currently in self-directed silver IRAs. Does placing part of that in gold create less volatility for the account? How does placing part of the account in gold work? You're muted. You're muted.
Oops, sorry about that. What was the percentage in silver? Again,
it sounds like it's all in silver right now. So I think the idea is, if I were to sell some silver, buy some gold, does that reduce volatility in the account?
Maybe a little bit. Silver is more volatile than gold, but they're both precious metals and they both travel together. The question doesn't state whether it's paper silver or bullion, does it?
I'm assuming it's a self-directed IRA, so I'm assuming it's bullion, vaulted bullion.
Yeah, well, right away, I'm not so sure. If it's vaulted bullion, depending upon your broker, you might actually be able to swap it without these huge bid-ask spreads, So the first thing I'd say is let's take a look and see where that bullion is vaulted, because maybe you could. If it's all silver, it is going to be a lot riskier. It's had a much bigger run than gold. And from here, might even still have more upside, but it's certainly going to be more volatile. We would recommend a mix of maybe 50-50 or even 2/3 gold, 1/3 silver, but I wouldn't necessarily say to do it if it costs a lot to do it. So I'd have to talk to this person, understand exactly what it looks like, who the broker is, that type of thing. If there's a big cost, I wouldn't bother. I would actually tell them to maybe just sell down some to cash and diversify the account a little bit. That's the way to reduce volatility, not just move to gold. The problem with gold and silver is so many people have this all-in thinking, and I understand why, because of the era that we're living through. But, again, sell down some to cash so you can do some other things. If it's not bullion, if it's actually ETFs, that's a lot easier. And then I would either diversify out of metals, or if they're insistent on being 100% metals, then I would probably go more towards 50-50 here, because the gold silver ratio dipped to 49 this morning. I don't know where it is right now, but it was 103 in April. And in COVID, it hit 120. I mean, we knew those were screaming bargains at the time, but what we didn't know is it would take years to be known. But now here we are at 49, and it's more normalized. I'd go 50-50 if it's paper gold in an IRA. That would be easy to do. If it's bullion, I'm not sure it's worth it. Depends upon the cost of doing it.
And Mike, that ratio, is that how many ounces of silver equals 1 ounce of gold? 49 ounces of silver? Okay.
All you have to do is take the price of gold, divide into it the price of silver. And, gold is at, 4,600 now, and silver is low 90s. So, it's about 50.
John, next one to you. I'm going to fire through a couple more. If the stock market bubble bursts with a significant drawdown of 20% or more, what do you expect gold, silver stocks, bullion and miners as well? Would they fall that much?
We've looked at this over history, stock market sell-offs and what gold and silver did, and it kind of depends. Generally speaking, in a just flat out sell off of the markets, unless there's like a hyperinflationary kind of environment, everything gets taken down with them. And it's oftentimes a function of the leveraged financial economy we're in. You have basically investment accounts getting margin called, and sometimes the best thing is what needs to be sold. Arguably, if precious metals are the thing, sometimes they got to get sold simply to cover margin calls on the other stuff that is falling. So it's oftentimes in this modern, kind of economy and financial market that everything gets sold in a swift way, even if it's short lived. So, for example, I think if we go back to the COVID decline in 2020, I think we saw gold sell off just as much as the stock market, but bounced back quicker. That's my base case expectation, that we would see a swift sell off in a lot of different things. But I do think that the long-term durable thesis of the fundamental reason for precious metals would likely cause that to be short-lived, perhaps even more short-lived, I think, and we think, than the stock market. We think the game of just printing money and adding stimulus to cause the stock market to bounce back in a V shape, that's running out of steam in some ways, we think, in part because we are much closer to an inflationary kind of blow up again, where there's consequence to rescuing the stock market. And I'll remind folks, we're in a midterm election. There's a lot of kind of reasons for politicians to think populist rather than markets. And I think it could be all assets could be subject to some significant sell-off if and when we do get that catalyst for a big downturn.
Thank you, John. I think we'll take this last question, Mike, with you. Mike, do you consider metals and IRAs different than paper metals? For instance, I'm assuming they mean metals and IRAs like vaulted metals, but they're also talking about the Sprott assets, like the physical Sprott, PHYS, PSLV. Please explain your thought difference between, I think, vaulted metals and paper metals that way.
All right, this is going to be controversial, but the truth is I think paper metals are way easier to use. The Sprott products are really good. PSLV for silver, PHYS for gold, CEF for a mix of about 60% gold, 40% silver. A number of our clients are in CEF. It's a nice mix. Fees on the thing are about 0.5% per year, about equal to what vaulting's like. They often trade at a slight discount. Right now, they're trading at a 3% discount. I'm surprised, actually, given what's happening in metals. They're not trading at a premium. But if you're a buyer, it's a good place to step in. And, there's no slippage. You basically buy near the spot, in and out. You can do it over and over if you want. Maybe that's a bad thing. So most people, I think, I like the paper metals. But that doesn't mean that you shouldn't have some amount of core position. So you got to really ask yourself how much you really want an Armageddon hedge, because that's what it is. The physical metals are an Armageddon hedge. Everything falls apart. The stuff hits the fan. Are you going to be able to pull out your silver or gold and transact with it? Still think it makes sense for people to have that, but do they have to have that? No. You have to decide for yourself what percentage you assign to that Armageddon scenario. 5% probably is what I would assign to it. Other people will say 90%. Those people want physical metals. That's really what it comes down to. What do you think the probability of an Armageddon type scenario is? What do you think the possibility is of confiscation? I don't think that confiscation is going to happen, because then the Fed would have to basically admit that everything was a sham ever since going off the gold standard. I don't think that will happen. Last time that happened, we were on the gold standard. So, but some people like to look at it, hold it, whatever. So there's no right answer. If you're more just looking for convenience and get in now at the best price, I would just use something like the Sprott funds, because they are in the Royal Canadian Mint in Ottawa, Canada, vaulted. They're not allocated. They're not segregated. I know that some people will point that out. I don't see that as a huge risk. So like everything, you got to decide what your bias is. My bias is towards the paper, especially here where you can't even buy silver for less than a huge premium, but you can buy the paper really easily. So, and then decide if you need an Armageddon stash, and then make that stash happen too. It's kind of the way I look at it.
Well, we're 3 o'clock. We try to stay prompt like this because I think most of us have a meeting right now to jump onto. Anything else for anyone here to add, Mike or John or Jay?
No, just want to say thank you for the questions. Thanks to our many clients here, and we see many friends that aren't clients on the chat as well. So thank you all for sharing your time with us.
Regina, thanks for setting this all up, everyone. Thanks so much. We'll chat soon, and we'll see you again here in about 1 month.
Thank you, everyone. We really
everybody.
appreciate you coming.
Bye.
Bye.